All right. So, hey, Todd, how are you today?
I'm good, Erin. How about you?
I'm doing very well, thank you. I appreciate you taking the time to hop on a call with me. So as we've kind of talked about before, when we're talking with friends and clients, we're, often asked for kind of market updates, prediction, just general information about what's happening in the local market. And I figured that it might be helpful to hop on a call with another local market expert like yourself. So to our friends and clients, this is Todd Hennessy of CrossCountry Mortgage of the Todd Hennessy Group. He's been in the business for 20 plus years locally. And, we've worked with him in the past personally and past clients as well. So I thought he might be a good resource to kind of hop on a call and just pick your brain a little bit.
Absolutely. And thank you so much for having me on. I'm happy to do it and honored that you thought of me. So thank you.
Yeah, I very much appreciate your time. And obviously, you're the person that I call often for insights. So it'll be helpful to, kind of get our heads together and share with our clients as well. So I think probably the most common thing that we get asked currently from a lot of our clients, new clients and past clients, is about interest rates. So I'm curious, can you just share a little bit of your thoughts on interest rates, kind of where we were last year, a little bit on where we are now, and what do you sort of see maybe happening as we head further into this year?
No, it's extremely common, obviously, in both of our worlds. Certainly, over the past few years, we've just seen kind of unprecedented times. So where interest rates during the pandemic and all the government stimulus drove interest rates to all-time lows, with so many people getting interest rates, in the 2s and 3% range. And then as we came out of that and started to kind of get back to normal, the government stimulus kind of stayed on for probably a little bit too long. And the Fed, then I guess in early 2022, they probably should have started raising rates very slowly in 21. And we probably would have been able to get away with a lot less of an abrupt change. But instead, they let it ride a little bit longer. And then in 2022, they had to do a much more significant raising of rates. And so essentially all of 2022, virtually, I think from probably starting in March or really even February, we saw rates starting to really rise all the way through the peak of interest rates in October of 2022. Rates kind of stabilized as we got into 2023. And then we saw them peak once more in October of 2023 when we saw interest rates hit over 8%, which I've been doing this, I guess, over 20 years now. And I haven't seen interest rates in the 8s since really my first year in the business. And even like a year or two before I got into the mortgage business, I was a realtor, and I ended up seeing interest rates in the 8s and 9s back in, I guess that would have been in the late 90s, early 2000s. But that being said, since October, this past October, where we saw that peak rate, the Fed kind of signaled that they believe that they've got a hold on inflation, and that inflation is already on its way down, and that they've done enough movements over the past year and a half to kind of suppress that. And so moving forward into 2024, they projected that they're anticipating 6 rate cuts in 2024. Now, whether we get 6 or not, will be, I guess we'll all find out here pretty soon. But I think it's pretty clear that we're going to get several. And so the projection forward is that rates are going to come down. And just on that news alone, we've seen a shift from, call it November till today, where rates went from, call it 8.5%, 8.25%, now down to somewhere in, call it the mid 6.5% to maybe 7% range. So rates are already dramatically better than they were. And I don't think that the general public is aware of how much better rates have gotten. And then kind of where we think they're going to go, to answer the second part of your question quickly, is just that the first big rate cut is expected to be in March. And if that ends up taking place, we should, which I think it's about a 70% likelihood in March. I think it's upwards of 90% by the May meeting. And so I think we're going to see rates get a fair bit better, call it by May. And by fair bit better, I think it's really likely we'll see something with a 5.5% to 6% range would be my guess. And then later in the year, we think the Fed is going to start doing a little less tightening in the marketplace and reducing the money supply in addition to future rate cuts. And they're going to enable they're going to start preventing their balance sheet from running off, which essentially what that's going to do is allow them to create, or interest rates are going to get a secondary reduction. So in addition to just dropping rates, just the lack of tightening, just allowing their balance sheet to maintain where it is today, will also improve rates even further. So I think by summer, we could see something even lower than the mid fives. There's crazy predictions out there, but even in the fours. But I think that certainly interest rates in the fives by probably late summer, maybe end of the year. Timing is obviously the question. Nobody knows exactly when all that's going to happen. But I think the good news is that they're going to go lower than they are today. So that's great. Did I answer your question there? Is that helpful?
Yeah, I think so. Obviously, I, as much as many other people have heard, in theory, we should have some rate drops this year. My secondary question was going to be when, hopefully, we might continue to see rates dropping. So obviously, fingers crossed, maybe as we head, towards the second quarter, the Fed cutting rates might have more positive impact for our buyers and for our sellers as well, because certainly, interest rates impact the whole market, both buyers and sellers. So I think that information was really helpful. I appreciate that.
Yeah, no, absolutely.
And I guess my sort of follow-up question to that is, as a buyer considering getting into the market right now, whether it's a first-time buyer, all of my questions are multi-leveled, but whether it's a first-time buyer, kind of the repeat buyer, maybe upsizing, or a lot of the business that we do is kind of the big downsize, what is your sort of piece or pieces of advice for people considering getting in the market right now, just in any of those scenarios?
Well, that's a great question, Erin. I feel like, most people aren't thinking that through. The general consensus would be to just wait it out, right? And that's kind of, I think, the mistake that a lot of people are making or considering making, is that people want to try and time the market, wait till rates are great, and then I'll buy my house. That's a great question. I know why you asked that, because you're an excellent real estate agent. So the key is for your clients who are in that position and considering doing it, you're much better to try to purchase a home now, let's call it 6 months, while interest rates are still better than they've been, may not be as good as they're going to get. But you're going to do so and be able to shop for a home with a whole lot less competition. One of the big things that happened with rates going up is that every time rates went, say, from 5 to 6%, a large percentage of people who were out shopping for homes were like, ooh, that's getting a little too expensive for me. I'm going to sit on the sidelines. And it went from 6 to 8. Even more people jumped off the train, and so on and so forth. So as now we've crested that mountain and we're coming down the other side, people are jumping back on the bus on the way down. So right now there's few people in the marketplace, just due to the seasonality of our business and it being inconvenient to move in the middle of winter. Here we are sitting with our first snowfall in, I think, over a year or 2 years. But the key there is that as the market, as rates start to go down and more people catch wind of that, more and more buyers are going to come back to the marketplace. And by the time when we get to summer, it's going to be highly competitive. So buying now, you're probably able to negotiate a lower price. You can always refinance later. In fact, a lot of mortgage companies are offering incentives to do that, myself included, where we're doing like a buy now, refinance later. So then that takes the obligation of trying to time the market. You just go buy your house when you find the right house, and then you can always reduce your interest rate later. So that's a great tool a lot of people are trying to take advantage of.
Yeah, actually, I was going to sort of ask a follow-up question of, for someone who got a rate in, say, December, is there a formula for the right time to refi if your rate in December was in the 7s or 8s, and in theory, June of this year, maybe we're looking 6, 5.5, something like that? Is there sort of a process to think through in that capacity?
Yeah, there certainly is. And so there's the kind of the old rule of thumb, if you will, of 1% drop in rates, which I kind of disagree with, although I think it's okay to kind of generalize that way. 1% on a $1 million loan is a significant drop, and that would be an enormous savings. And hence, a 0.5% drop on $1 million loan would probably be sufficient. Most people would probably take advantage of that, versus a 1% drop on a $100,000 mortgage. Most people would say, oh, that's not enough of a savings for me to want to do it. So It's all relative to the size of your mortgage. But you would really, the key there is to stay close to your loan officer. So if you've purchased a home, call it in December, and you hear rates are dropping and your agent or your loan officer hasn't reached out to you ahead of time, just to call them and say, hey, does it make sense for me to refinance now? And run those numbers. I think my concern moving into this 2024, we're going to be in this environment where rates are going to drop. It's going to be new news, right? All we've heard is bad news. Rates are going up, and then all of a sudden we'll start to really hear the humdrum of rates getting better. And there's going to be a significant chunk of people who probably run the risk of refinancing too soon. And so I think it's critical to meet with your loan officer, run those numbers, make sure the savings is good. But I would advocate that, unless your rate is in the 8s, refinancing, you could probably do so now in the 6s and get a great deal. But I'd almost tell most of those people just to pause until, call it March, April. I think that rates are likely to be much better by that point. And then those folks can certainly take advantage of that. And then maybe they never have to refinance after that because the rates are pretty good and their savings was dramatic. But for those people who have a 7 or a 6% rate now, they're probably not going to be able to refinance until much later in the year. So I'm just a little worried some people will jump the gun because they heard rates dropped 0.5% or 1%, where if they waited 6 more months, it might go down 1.5 or 2%. So that's the key there, is working with people who aren't just going to tell you to refi at the first glimpse of savings, right? To maybe tell you to be patient and give it another month or two, as it's likely to get better.
Sure. Well, I feel like, that kind of covered a lot of what we end up coming across every day when we're, connecting with our past buyer clients who have recently purchased, or even staying in touch with clients that have purchased many years ago. Are there any other sort of insights or thoughts or anything that maybe we sort of left on the table that you think would be valuable to share?
Yeah, I think the general sense is what you're saying is the this market has taught us a lot of things over the past few years. That time is of the essence. And if you're needing to buy a home, the process of buying a home right now is more pressured in the sense that not you, the agent, or in my case, me, the lender, is pressuring the client to make a decision. It's more the marketplace, right?
Sure.
So preparation is totally key. When you go out and look at properties, if you find something you like, you're probably, if you really want to buy it, you probably have to make that decision pretty quickly to do so. Otherwise, by a day or two later, if you're thinking it over, it's probably sold already to someone else. So in an effort to help your clients, if somebody is thinking, hey, we're going to buy this year, we're probably not buying till summer, that's fine. And that's a great goal to have. What I would encourage those people to do is to reach out to you the minute that they're having that thought, and really just schedule some time about what they're looking to do, when they're looking to do it, long in advance. And then prepare financially, budgeting, all of that stuff. And then using all kinds of tools. I know one of the tools we're using in our world, and I know other banks are instituting something similar, which is getting fully approved for your mortgage to the point of a mortgage commitment, as opposed to kind of the normal or traditional pre-approval. What that does is it just sets you apart as a buyer from other people in the marketplace, kind of stack every chip in your corner. You're prepared, your mortgage is done, you've got a great game plan with your real estate agent. And by the time you're out there looking, in the event something pops up, you are capable, ready, and confident enough in yourself to just pull the trigger and do what you got to do. For those people who kind of go in willy-nilly and less prepared, the home shopper or tire kicker from 5-10 years ago, that doesn't work in this market. And those people see so much opportunity where they go out and they see a beautiful house and they lose it. And then there's that emotional feeling of, oh my gosh, we lost our dream house. And they compare every home to that moving forward. So, I know you are just such a wonderful agent, you and your whole family, frankly, and the amount of work and effort that you put into your clients, you really do them a service in your preparatory stages. So, kudos to you for bringing that kind of information to your client, because you're doing them a huge favor. But preparation is key in this market. Having every chip stacked in your corner, and then just having a game plan. And if that game plan is you run across a property that is of not, maybe looked good on paper, but once you visit it isn't for you, that's great, right? You're just over prepared and it's easy to walk away, but you're kind of preparing for the one-off when you find something that, wow, we didn't expect this and we want it. You got to have your ducks in a row in that case.
Yeah, I mean, that's a really great point. I mean, the speed with which this market moves, we find that if people aren't already sort of in a position to know what their buying power is, they end up feeling like they missed out on things.
Yeah.
And I guess maybe a sort of follow up to that is, and we hear this a lot, is, you know, how long relatively does a pre-approval last for? Because I think people worry about doing the process if, you know, they're really 6 months or a year from now. So, you know, can you sort of talk through that a little bit?
Yeah, that's a great question. And actually something that's relatively new, a lot of people are not aware of. The old kind of standard pre-approval process would probably last about as long as a credit report lasts for, until the credit report expires, and then your approval would have to be updated. And that was usually somewhere between 90 and 120 days, depending on the vendor. That said, that whole process of credit pulling has changed too, which I think is going to really start to benefit a lot of the home buyers in the marketplace to prepare earlier. And what I mean by that is most people would say, hey, I don't want to have my credit pulled because it's going to hurt my credit too early, and then have it expire and redo it again. A lot of companies, mine included, are doing what's called a soft inquiry on your credit report now. So we're able to fully approve you, get everything squared away, but it has no impact on your credit. And so if that expires in, call it 120 days, it's a click of a button, we refresh it, and it has no impact on the credit score. So technology and advancements in the credit industry have really enabled, you know, companies that are using that technology to really allow their clients with no fear or obligation to prepare long in advance and not worry about hurting their credit. So that's a huge tool. It's a subtle difference, but it's an important one. So to any of your clients who are watching this, who out there who are thinking along those lines, like, we'll get ready later, I would do it sooner. It doesn't, you may just be way ahead of the game, but you'll learn a lot. And inevitably, I always tell people, and you've probably seen this too, Erin, it's like the minute people start thinking about it, the more you look, the more likely you are to find. And it always is like, oh man, we weren't planning on doing this, but here we are this weekend.
Sure.
Place popped up out of nowhere. And so much better to be prepared long in advance there.
Yeah, we've recently been working with a couple clients that when we get to the settlement table, they're like, how did we get here? Like, when did that ball get rolling? And I guess, yeah, you know, knowing in particular that the soft credit pull is an option as well. I mean, it feels like there's no downside to getting pre-approved if for no other reason than you, a client, or you and your agent have a really clear picture of what your purchasing power looks like. And then you can make decisions accordingly. Need more time, need more savings, or you're ready to jump into it now.
Yeah.
I think that a lot of our clients will be happy to hear that, just because I don't think people have a clear sort of understanding of that process.
Yeah. And I think you bring up a great point, and I kind of put this one to you a little bit as the expert of seeing what people are going through. My, you know, anecdotally, I've seen clients go through this where, you know, people go out and they might tell you, we want 4 bedrooms, you know, 3.5 baths in these school districts or what have you. And they kind of in their mind have this picture of this home that they want. And to buy that home, they know about what they have to spend. And so it's easy for us to prepare financially for them. But the reality on the ground is there's only a few of those homes, right? And then when they're gone, all of a sudden they start looking at other things that are maybe not exactly what they were thinking. Maybe it's like more expensive and there's different things that you have to do to accommodate that. Or maybe it's less expensive. It's just a condition issue and they're going to have to like renovate it or improve it, right? So
Sure.
All of those things, in my view, is about having that understanding and preparation on your own mindset that, hey, I may not find the unicorn house that I'm looking for. And hence my viewpoint has to be a little broader. And then also how I will buy that home, depending on what I find, might change.
Sure.
So the financials may adjust to accommodate a different style of purchase. So kind of just having a broader spectrum of what you're open to or considering, and then understanding how that would change financially, all of a sudden then it's not as scary. So as people walk out there and they find a house that needs some renovation, they're like, we already talked through this, how this might work.
Sure.
And this is great. This could be cool for us. It would look great if we did the X, Y, and Z to this home. So I'm sure you've seen some of that in your experience, but early preparation there too is key.
Yeah, I think, you know, limited inventory, in addition to, you know, conversation around interest rates, conversation around limited inventory is kind of the other biggest elephant in the room, I guess. Yeah. And yeah, I mean, a lot of our buyers that are pre-approved and out looking do, you know, sort of shift their perspective as time goes on. But, you know, the relationships that we have with our preferred lenders are really helpful in the process, exactly as you just said. If someone's sort of thought process about what they might be buying shifts, we've got the information that we need to help our clients make effective decisions, knowing what their, big financial picture is. So I think that that's very helpful.
Yeah. And it's just much easier to digest that information when you're like, not having to write an offer in an hour, right? If you're able to have that conversation, not under pressure, and you're like, oh, cool. Yeah. Okay, cool. So if we found a house that needed renovation, we just might put less money down and use more of our down payment for renovations. And then we can refinance later when rates improve. It's like, oh, makes total sense. But if somebody found a house today and they're like, how do we do this? It's like, all of a sudden the temperature goes up quite a bit and stress gets up. And so all avoidable if you're just thinking about it at a time.
Right. Well, I think all of this information has been very helpful, and hopefully there's some nuggets of information in there that our friends and clients, can take away of just feeling better prepared for the market, whatever sort of situation they're in. So I very much appreciate your time. I very much appreciate your insights, and I hope people find this helpful.
Yeah. Well, listen, thank you so much for having me on. It means the world to me that somebody of your caliber trusts me to help your clients and even in this little conversation here. So it was a pleasure, and I'm happy to do it. Thank you for having me.
Awesome. Thank you so much.
Yeah. All the best. Take care.
See you.